Did you know that 90% of traders fail because they don't understand how to read charts properly? Crazy, right? But don't worry, today we're fixing that. Understanding how to read stock and crypto market charts is the key to making smarter trades and avoiding costly mistakes. In this video, I'm going to break down everything you need to know, from the basics to some powerful tools that even the pros use. By the end, you'll feel way more confident navigating the charts, whether you're trading stocks, crypto, or anything in between. So let's dive in. Basics of market charts. Alright, let's start with the basics. When you open up a market chart, what you're looking at is a graphical representation of price movement over time. The most common type of chart you'll see is a candlestick chart, and for good reason. It's powerful, but don't let the name intimidate you. Candlesticks are just bars that show the opening, closing, high, and low prices within a specific time period. You can think of them like a story. Each candlestick tells you what happened in that time frame. Let's break it down. Open price. This is where the price started during that time period. Close price. This is where the price ended at the end of that time period. High price, the highest point the price reached. Low price, the lowest point the price reached. Now, candlesticks come in two types: bullish, green or white. If the price closes higher than it opened, the candlestick is bullish. This shows the market is trending upwards. Bearish, red or black. If the price closes lower than it opened, the candlestick is bearish. This shows the market is trending downwards. By looking at these candles, traders can get a snapshot of market sentiment and decide whether it's a good time to buy or sell. Pretty cool, right? You might also see other types of charts, like line charts or bar charts. A line chart is the simplest. It just connects the closing prices with a line, which makes it easy to see the overall trend, but it doesn't give as much detail as a candlestick chart. Bar charts, on the other hand, show similar info to candlesticks, but in a less detailed way. They're not as popular because they're harder to read at a glance. So, which is best? Candlestick charts are the most useful for beginners and experts alike because they give you more information to work with. You get to see how the price moved throughout the day, not just where it ended up. Key technical indicators. Alright, let's level up and talk about some key technical indicators, tools that help you analyze and predict market trends. Don't worry, these sound more complicated than they are. Let's start with the moving average. A moving average, MA, is just the average price of an asset over a set period of time. There are two types you'll see often. Simple moving average, SMA. This is calculated by taking the average of a certain number of past prices. For example, a 50-day SMA averages the closing prices of the last 50 days. Exponential moving average, EMA. This one gives more weight to recent prices, which means it responds faster to price changes. Why does this matter? Well, when the price is above the moving average, it's generally seen as a bullish signal, buy. When the price is below, it's bearish, sell. Moving averages help traders spot trends. If the price stays above the moving average, it's a good sign the trend is upwards. Next up, we've got the RSI, or Relative Strength Index. The RSI helps you figure out if an asset is overbuilt or oversold. Basically, if it's due for a pullback or if it's about to keep running. The RSI moves between 0 and 100. Above 70, overbought. Prices might be too high, and a pullback could be coming. Below 30, oversold. Prices might be too low, and a bounce back could happen soon. So, if the RSI is above 70, it's a signal to watch out for a potential reversal to the downside. If it's below 30, you might be seeing a buying opportunity. Now let's talk about the MACD, or Moving Average Convergence Divergence. It sounds complicated, but it's actually just a trend-following momentum indicator. The MACD is made up of two lines. The MACD line and the signal line. Here's what you look for. When the MACD line crosses above the signal line, it's a bullish signal, time to buy. When the MACD line crosses below the signal line, it's a bearish signal, time to sell. The MACD is great at showing you when the momentum is shifting. When the lines cross, it's like a red flag or a green light saying, hey, something's changing. Lastly, volume indicators. Volume is the number of shares or coins traded within a certain period. It's an important confirmation tool. A price breakout, meaning the price breaks above or below a key level, can look strong. But if the volume isn't there to support it, the breakout might fail. High volume shows that traders are really behind that move. So if you see a price breakout with high volume, it's more likely to be a legitimate move than if the volume is low. How to spot trends and patterns. Now, let's dive into trends. In the market, there are two main types of trends. Uptrends, bull markets, higher highs and higher lows. Downtrends, bear markets, lower highs and lower lows. Support is the price level where an asset tends to find buying interest, causing the price to rise. Think of it as the floor. Resistance is the price level where selling pressure causes the price to fall. It's like the ceiling. So when the price approaches support, it might bounce up. When it reaches resistance, it might fall back down. The key is watching these levels closely. And don't forget about chart patterns. They're like the market's way of telling a story. For example, a head and shoulders pattern is a trend reversal pattern. When you see a head and two shoulders, it might signal the market is about to turn bearish after an uptrend. Another popular pattern is the double top / double bottom. A double top is a bearish reversal pattern that happens after an uptrend, while a double bottom is the opposite, a bullish reversal after a downtrend. Common mistakes beginners make. Before we wrap up, let's quickly talk about some common mistakes beginners make. First, don't ignore volume. Volume is a key indicator, so always look at it before making a decision. Second, don't over-rely on one indicator. No single indicator is foolproof. Use a combination of tools to get a clearer picture. Lastly, emotional trading is a big no-no. Stick to your plan, don't chase the market, and always manage your risk. To sum it up, reading market charts isn't as hard as it seems. With candlestick charts, key indicators like moving averages, RSI, and MACD, and understanding support and resistance, you've got the basics down. And remember, the key to success is practicing and staying patient. If you're just getting started, I highly recommend using TradingView for charts and Binance for trading. They're both free and beginner-friendly. And hey, which indicator do you want me to explain next? Drop a comment below. If you found this video helpful, don't forget to like, subscribe, and hit the bell icon for more market analysis tips. I'll see you in the next one.